All right, today we're going to dig into a proposed U.S. trade policy that, on the surface, has absolutely nothing to do with coffee, but could still end up making your morning cup a whole lot more expensive. It seems like a weird question, right? But the link between the Boston Tea Party and your daily caffeine fix is, believe it or not, more direct than you might think. We're about to see how a brand new tariff plan could stir up its own kind of trouble. So, yeah, let's get into it. So, first things first, what exactly is this policy? Well, at its core, it's a new, really predictable, rules-based way for the U.S. to set taxes on goods coming in from other countries. The whole idea is called a discounted reciprocal tariff, and it's pretty simple, really. The U.S. basically looks at the tariff another country charges on American stuff and says, okay, we're going to charge you a tariff back, but we'll give you a discount. It's not random, it's a system. And what's really wild is that this entire complex policy can be boiled down to this one simple formula. If X is the tariff another country charges the U.S., then Y is the tariff the U.S. charges back. And the key number here is that 0.49. It basically means the U.S. tariff will always be about half of whatever its trading partner is charging. And here you can see that discount in action. You know, a trading partner might hit the U.S. with a pretty high tariff, let's say 20%. But under this rule, the U.S. tariff back is automatically lower, in this case, about half. And remember, this happens every single time, just like the formula says. Okay, but here's the thing. A simple rule can have really complicated results. This policy doesn't hit every country the same way, and once you start mapping it all out, you start to see a very clear pattern of who wins and who loses. Now, to understand that map, we need to talk about one more thing, the Economic Complexity Index, or ECI. The easiest way to think about it is like an economic report card for a country. So a country with a high ECI, like Germany, makes all sorts of complex things. A country with a low ECI might just be exporting a couple of raw materials. So here's the key. When you take a country's tariff level and you combine it with its economic complexity score, you can actually sort pretty much every country on Earth into one of four groups. And this is what it looks like. Countries just naturally fall into one of these four boxes. This little grid, it kind of reveals a hidden structure in global trade. And it's the secret to figuring out who's going to do well and who's going to get hurt by this new policy. I know. This is all a bit abstract. So let's bring it all down to earth with something most of us know, and maybe can't live without, coffee. Just so you understand the stakes here, get this. In 2023 alone, the U.S. imported over 8.2 billion worth of coffee. This is a massive, massive market. So any little disruption to the price, yeah, millions of people are going to feel it. And boom, here's where it all comes crashing down. Under these new rules, Vietnam would get slammed. Because they have high tariffs on U.S. goods, their coffee would suddenly face a U.S. tariff of almost 40%. Meanwhile, competitors like Brazil and Colombia would get off with much, much lower tariffs. This isn't just a small tweak, it's a game-changing distortion of the market. So what do you think happens when one country's coffee suddenly becomes way more expensive than everyone else's? Well, it sets off what economists call a substitution effect, or what we can call the Great Coffee Switch. And we all do this every day. It's called the substitution effect. I mean, think about it. If your favorite cereal suddenly doubles in price, you're probably going to grab the store brand sitting right next to it, right? Well, the exact same thing happens with huge global commodities like coffee. So here's what the U.S. coffee market looks like right now. You can see Vietnam, Brazil, and Colombia all have a pretty decent slice of the pie. This is our starting point. Okay, now watch what happens when the model applies the new tariffs. Vietnam's slice of the pie just gets crushed. But that demand doesn't just vanish, it moves. Importers switch away from that now expensive Vietnamese coffee and start buying way more from Brazil and Colombia. Their slices get a whole lot bigger. Now, this is all pretty fascinating from an economic point of view. But what does this big global shuffle actually mean for you, the person who just wants a cup of coffee in the morning? Let's just cut to the chase and ask the single most important question. What's the bottom line? What's the final cost of this thing for the average American consumer? The research on this is crystal clear. The most likely outcome is simply this: higher prices for coffee right across the board. And here's the breakdown of why. First, even with everyone switching to cheaper options, the overall cost to import coffee just goes up.
and that cost gets passed right on to you. Second, you're talking about a massive, sudden change to supply chains that have been built up over years. That's messy and expensive. And finally, all this chaos creates instability in the market, and that almost always means higher prices for us at the checkout.
And that brings us full circle, all the way back to where we started. It's a powerful reminder that when policies mess with the price of everyday things, whether it was tea back in 1773 or coffee today, the fallout can be much bigger than just dollars and cents.
So, no, we're probably not going to see a modern-day coffee party. But this whole analysis really leaves us with one critical question. When you look past all the formulas, the charts, what's the real price of a policy like this? And who is it that ultimately has to pay?